Yeah, so sometimes you might find that you have something like this. Um what I've told you, it was something like this, right? Here it's very freely. It's just go down, but right now I have this, we call it inside formation. So this one is inside formation. You see? So this inside formation, as we discussed it from here, um, what we did is we were waiting for this. We were waiting for this place, right? So the market come here and take a sell, right? But sometimes you find something like this. What will you do? First of all, you will mark your your point of overthrow right here, and then you will mark here. So you will have two places that there is high probability that the market will reverse. So the market might come to here and give us the pattern. If we see this pattern and then we will take entry, we will sell. But sometimes market is tricky. It comes here and then it doesn't confirm. As we all know that we are not supposed to take, if it doesn't close here, it didn't break the structure, right? Sometimes you find that it comes here, it creates a head, neck, and then the other shoulder is not clear and then it goes up. So you're not supposed to to be to 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 be very, you have to be very careful. You are supposed to wait for it to break. If it breaks here, and then you will wait for a market right here, and then we'll take a sell. If it didn't break, and then you will wait for a market to come right here, and then you will wait for the same pattern in 30 minutes, and then you will take the entry, and then you will go down, right? So this is what we will be doing. Let me show you one example how we do it in the charts. All right, this is euro Audi, right? I know, Amiru, you're not trading euro or GBP, or you just trading Audi USD. Okay, we'll find another time so that we can look for entries in Audi. Actually, last week I took a trade with your pair Audi USD, and it was a very good trade, very profitable trade. Okay, so you can see there is a lot of demand and supply. But let me show you from here. Let me cut it first. There is good, there is entry that I took here. It will be very, the example will be very clear, right? Do you see this, right? This is a good supply. We have here a good supply, but we are trading what we see. So when market will come here and it won't confirm, then I will wait for this. Okay. So I will mark my area, right? Okay, my supply area, right? And then what I will do, I will go to 30 minutes, right? In 30 minutes you can see, you have seen the pattern, right? The pattern is everywhere. You just have to back test, man. Everywhere you can find a demand or supply that doesn't have a pattern. And if it doesn't have a pattern, you will use a last candle to be liquidated by price right here, as I told you in the previous episode. You can see here. So what will you do? What you do is, if you can just put here, this is our point of interest. So we will wait for a price to touch this line, and then we will wait for a price to engineer to give us the same what? The uh same uh pattern that we see here, and then we will get in. Okay, so this is 30 minutes, and then we will let it play. We will put an alert right here, right? You see the price have come to our point of interest, right? So after come to our point of interest, okay, so if you are not very familiar about break of structure, you should, maybe I will create another one, but it's very basic. Everyone should know the the break of structure. Okay, so you can see the pattern is right here. Have you seen the pattern, right? I think everybody has seen the pattern, right? So we wait. We are not jumping on the market. We wait. One thing on on break of structure, if this candle, the last candle to be liquidated by price, if the wick has, it's above the body of the farmost deviation of this candle, this is the last candle, right? This is the last body. We can put in a line. You see, this is the last one, right? If this, the previous candle, the last high, if the last high candle, it's longer to the wick of the last candle before reversal, you will take the other one. This one will be your liquidity engineer, not this one. And you can see back into, you see the wicks. The wick is, you can see it's above the body, above this body. These wicks are above this body. So this one, it's not the liquidity engineering point. You will choose the last, the below one, this one. This one will be, this one will be your liquidity engineering line, and the break of structure will be right here. Okay, okay. For if these candles were closed, the candles and the wicks closed, the candle and the wick are supposed to close below this body of the last candle before reversal. So if it is the wicks, it's above this candle, you will take the previous candle, the previous lower low, which is this one. So this one is your area of entry. This one will be your area of entry, and this one is the break of structure. So when the market was here, right? When the market was here, you already know that these wicks are above this body. So you know this is your area of entry. So what you do is you wait for a market to break it and then to come back to this area. And your entry will be right here. This one will be your entry. So you have to be patient. This one will be your entry. Okay, this one will be your entry, and then your stop loss will be up there. Okay, your stop loss will be up there, but if it gives you more than 10 pips, you just count 10 pips from here to, you just count 10 pips from here. Let me try to put it. You just count 10 pips. You just trade only 10 pips. It will never exceed 10 pips, regardless of the structure, because the entries are sniper. So that's why we say we are trading on liquidity pools. Okay, so we will wait for a price to break the structure. Okay, right here, the price already break the structure. We will wait for a price to come to this line, and this is our entry, right? You wait. You can see a price came up to here. It didn't take our our entry. You don't panic and jump on the market. No, you wait. Just put your limit and wait. The entries are always sniped. Just wait. You can see there the entry. You see, the price came to our entry, because sometimes when you see, you can see the move like this, and you say the maybe it's spread, maybe it's what. No, it's not spread. It's, you have to be patient and wait for your entry, because sometimes you may jump here and then the price may do manipulation, So wait on your price, because when you jump on a trade, you increase your risk. Your stop loss pips won't be 10 anymore, will be more than that. So you have to wait on your entry. You can see we get the entry, which is very sniper. It's utilized few pips, and then you can see how many pips just went. Okay, we can go back to 4 hours. Okay, you can see this is where you get out of the market. The last, you see this, the demand, you see demand, this is the demand. The demand will be your way of getting out. So this our entry, and when it touch here, it's supposed to be your exit. Let's see how many pips that we collected. See, it's 176 pips. So if you use even 0.1, you have 176 pips. If you use 0.5, you have like maybe 600 pips. You see, so if you are in a prop firm, you just need just one trade to get in to another phase. You can see this was I took this entry. It was Thursday, December 7th, and then what time was it? It was 5 p.m. And then on December 8th, 5 p.m. It's just 24 hours. You can pass your prop firm account in just 24 hours. Okay, so you don't have to overtrade. For me, I just trade sometimes 3 up to 4, because I have a lot of accounts. I have like 4 accounts, and some of prop firm don't allow copy trade, so I have to find other pair to trade. But when my capital is 200, I want to have one account that I can trade only 1 to 2 trade per day, because I collect a lot of pips. So what I have told you, it's very unique. You may not find it anywhere, because every bank is doing its way differently. So you can see how we enter this trade. So you can go and back test it, and you'll find it. In the next session, I'm going to show you how we do liquidity flip. There is liquidity engineering and liquidity flip. So if you know these two, you'll be you'll be a monster, man. You'll be killing the market like no other, man. So this is how we do it. So you can back test it. Remember that you get out of the trade when you see the demand. You have to get out of the trade. Sometimes you may take your stop loss and put here, and then see what the market will offer. But most of the time I will be looking 30 minutes here. I get a confluence, maybe waiting on it, waiting for it to shift, and then you go back. So you can just use one pair, but you can collect more than 200 pips. You see, let's see what happened after that. Have you seen? It's just reverse on this, and when you go back in 30 minutes here, you might find something here that led to price to go up. So you can take a trade here, and then you get out here, you take another entry here, you get up. That's how we do. So that is liquidity engineering with an example. If you don't understand, please consult me. I'll give you the clear information. Even we can do a zoom, and I can make clear for everyone to understand it.